Hello everyone and welcome to the third class of Multibagger Stock Ideas. Okay, so in today's class we are going to be doing a revision of what we learned, and as I told you last time, the only way to learn is through examples, and two is revision of the concepts that we have covered. Okay, I would request all of you who have done the excess assignments given to you last time to please post it to me on WhatsApp, and then we will take it up from there. Okay, so today we are going to go through these the various nuances that we learned last time, and today we are going to actually uh, give you a real taste of how it goes. So without much ado, let's get down to the subject matter on hand. Okay, but before we go ahead, I would like to reprise the course content to people who are new and logging in and still taking the trial. This is the final class which I am giving as a trial, and anyone wanting to join, continue henceforth will have to pay up. Okay, so this course is conducted online. It started on July 18, right? There are 9 weeks, 2 sessions per week, 2 hours per session. Classes 1 to 4 are an introduction to the proprietary 12 dimensions investment toolbox. So, here we discuss all the concepts with examples so that they make firm inroads into our head, and it will become a kind of a script that you play out when analyzing each and every stock. Okay, and so whatever we learn in these 12 dimensions investment toolbox, over class 5 to 12, we will be uh, applying it to 8 different stocks in 8 different sectors. Here we will also be undertaking a con call of a particular management if and only if it is possible. Okay, then classes 13 to 18, we will be looking at the various aspects of portfolio building. But before that, let me tell you one thing is that once you have done classes 1 to 4 and all the assignments you do, and from classes 5 to 12, if you go through these diligently with me and just reassess them once and just take the exercises that I'm giving you. These exercises don't take very long to conclude. Uh, you know what? Your learning curve will be extremely high. Okay, and classes 13 through 18, we will talk about the various aspects of portfolio building, how to sort data, preparing your screeners, how do you mine the data, how you manage the data, and then the various small we look at all this. And then we will have a class open session where subject matters which are not discussed, we will take it up. This is also be supported by a WhatsApp group which will start from tomorrow for those, and it will be exclusively for the people who have paid up. The fees will be about 15,000 plus 18% GST, which is non-refundable. Video recording will be available for offline viewing, and there will be PDF notes will be provided. Okay, so and if you have any more information you need, you can WhatsApp me on 7021216247 and mail me at schoolofmarketstudies@gmail.com. So thank you for bearing with me, and let's reprise the investment toolbox. So an investment idea has an extreme high probability of turning out to be a multi-bagger, which passes the rigorous test of the 12 dimensions. So if you believe that on all these 13 dimensions, you feel that the stock is scoring positively, then you will be fairly certain that you are in possession of a multi-bagger. And it is only the probability that it will be a multi-bagger, because a multi-bagger is a fact proven after it has the milestones have been achieved, right? So we have seen in class 1 the first three uh, dimensions, that was leadership, business prospects, business readiness, and class 4, 5, and 6 we had seen the peer set analysis and evaluation, past performance analysis, and scenario forecasting. And we had seen how to track the progress of the forecast, monitoring it, validating it, and reassessing. So that all these six we will do today. And in this, we are going to introduce only one more concept, which is operating leverage and moat. Okay, so normally we would have taken up three concepts that are operating leverage, valuation, potential re-rating, and stock selection through criteria elimination. But what I'm going to do is I'm only going to stick to the concept of operating leverage and moat. And in the next class, we will do the uh, the 8, 9, and 10, which is valuation, potential, and re-rating, stock selection through criteria of elimination, and scuttlebutt, ardor, and zeal. So that we will take up uh, next time. And the mindset of multi-bagger investing and 6D investing, we will keep touching on as we go through the classes. Okay, so I hope you're all set, and if you would like to just take a deep breath and let's dive into the case study that we are taking up. So the stock that we are going to look at today is CDSL. Okay, so everyone knows what CDSL is. It is the Central Depository Securities Limited, and let's see how this company scores on the uh, first dimension of the analysis. So for those of you who are not familiar with CDSL, so what does CDSL do? It is a depository company, and all your dematted shares, etc., and other financial instruments are held with them. Okay, to prove it, to give it to in very short, and so we look at 5 factors which are there. Who are the promoter owners? Who is running the business? The quality and pedigree of the management team, business processes, and corporate governances, right? So on this, let us see how does the company score. So what you should do is actually go into the website and pull out all the data with regards to uh, the following factors. One is the board. So if you notice, the board has got composition of 10 dignitaries, right from Chief Election Commission of India, former and CMD IDBI Bank, okay, International Banking Group, uh, Chairman and MD of Bharat Heavy Electricals, uh, from BSE, from Standard Chartered Bank for Strategy, Process and Governance. And you also have Usha Narayanan, who has been the former executive director of SEBI, right? So you have a board which constitutes of people who are been in the regulatory and government kind of organizations. So they are very used to bureaucratic processes, and here there is uh, extremely high emphasis on regulation, and because they're dealing with your precious shares, right? So we have an eminent and experienced board from banking, SEBI, regulation, exchanges, and there is also gender diversity. So what follows is that you have a very ethical board, okay, from various governments. So a person from the election commission, a person from SEBI, from the exchange, right from the strategy, process, governance, so all factions, and you have a managing director and CEO who has got the support of the board, and he has been recently nominated for another period of 5 years. So there is a lot of continuity in the management process also, isn't it? Secondly, it's a well diluted company. Shareholders, the promoters own 24%, and the rest is owned by the public. So it's a there is no concentration out here, right? Okay, they also have a governance framework in place, right? So these days, a governance framework is having it extremely positive. Being corporate social development, being social businesses is very important. I'll just give you a direction to this. On page 3 of Times of India today, you will see the ITC chairman's speech is there. So you just go through it and see how much emphasis they are giving, because they are a sin company, that is, they make cigarettes, right? So they have to show that they are very socially aware, etc., etc. And so you just go through it to see what elaborate lens the company has gone to show that they are a caring and a social company, right? So having so many policies in place clearly shows that there is a lot of business process, governance, and everything is well laid out. Okay. Now we come to the dimension 2, where we talk of business prospects. So if you're buying into a company, what are you looking at? You want to see कितना कर सकता है, कितना grow कर सकता है, opportunity क्या है, who's the competition, right? Whom are you up against, right? So first thing is that India is a very underpenetrated market, and I just picked out a small clip from a US magazine. I will just read it out to you. So what it says is it's about the US markets, and it says this was in 1999. Okay, so the share of households with a stake in the stock market was just 19% in 83. Okay, and it was not too long after the infamous death of the equities business cover. So just see classic things, that what comes in the news, buy the rumors, sell the news. So the news was death of equities, and see what happened after that. In fact, from 19% after reading death of equities, what would you expect? Uh, that the thing would go down, right? Ownership. No, but it actually rocketed, and it hit 23% in 92, right? So from 1983 to 1992, it took a lot of time, and finally at the end of 1999, the equity allocation by investors was well over 50%. Okay, so similarly, the equity cult is going to catch up in India. It's already showing strong promise. So India is currently at 6 to 7% of equity and household investment, and SIP and AUM flows to equity are only increasing. So this is an underpenetrated market. We are in low single digit, and this market can easily grow 7 to 8 fold. The US did it in about 17 years. I think we can do it in about 6 to 7 years. I think outside 10 years. So 2027, 28, I think we could be probably at 30 to 40% being retail. So that is the huge, uh, how can I say, the revenue potential that is there. Okay, if you see the monthly SIP numbers, 7-8 thousand per month, unheard of earlier, now moving to 12-14 thousand a month. So month on month there are increases. If you look at the AUMs under management of Kotak, classic example is Edelweiss. Edelweiss has grown phenomenally from 33,000 there, I think close to 80-85 thousand in a matter of 2 years. Okay, and if you gauge the response to the HDFC AMC IPO, you know, not not undermining the fact that it was promoted by the HDFC AMC, okay, which is a very, very reputed management, but the fact that an AMC IPO could generate so much of demand shows that people believe in the potential of it being a very underpenetrated market, right? And the other aspect is the opportunity heat map. So it's it's a sheer duopoly business. There are only two players in this segment, CDSL and NSDL. And if you track the movement of CDSL, okay, NSDL had a 60% market share for almost 4 years, and see how their market share of CDSL since then has been moving. So every year it has almost gained a little over a percent. So today we are at 44, they're at 56, and let us see in the latest, once their annual report is out, what do they predict. Okay, so apart from this, what is the opportunity that is there? So government has a desire to consolidate all financial assets into one report format. So your demat statement will be your repository for the following: your equity investments, insurance, corporate holdings, commodities, mutual fund, real estate, and bonds. In fact, I think the two biggest outliers which can contribute very, very significantly is going to be becoming a repository for commodities, and second is being a, so the government, you know what it wants, all the private limited companies and public listed company, it wants to dematerialize the unlisted shareholdings by September, isn't it? So that is going to significantly improve the business potential of these two companies. While the company has not announced its plans on its monetizing this opportunity, we plan to meet them very shortly to get a heads up on this. So we are just waiting for the results to get out. So this is the kind of potential that is there, and it's huge, the number of companies that are there. So this clearly shows three things: underpenetrated market, two is duopoly, only two players, very comfortably split, and we are gaining market share. And third thing is humongous opportunity from regulatory changes, right? So a regulated business, it has its own strengths. We saw that on the ownership and owner and business prospects. So it's a good business with huge ramp up and a good management. So obviously you won't expect this stock to be available cheap to you. So it was in a green quadrant, right? So now let's come and see the business readiness and growth curve of this company. Okay, so what are we talking of? Okay, so the company has four subsidiaries. So the parent company, which does the DPs of clients and corporates, isn't it? Then it CDSL Ventures Limited, which is for the brokers, capital market intermediaries. Then it has CDSL Insurance Repository, and it has the commodity repository. So these businesses are just slowly panning out. Okay, now what we are seeing, business readiness and growth curve. So what do we mean by business readiness and growth curve? We will see what are the, as we saw the opportunity. So now we analyze how the company is set up to garner this kind of opportunity that we saw, and what is the growth curve. So we have already highlighted the growth curve to you earlier. Okay, but let's look at the, from the SWOT analysis, purely the opportunity and threat that are there. So it continues to focus on developing new DP relationship and leveraging its existing DP network, and continue to introduce new offerings and scale up recently started businesses. It is investing in upgrading IT infrastructure, investor education role it plays, and it does sale, purchase, and transfer of securities in India. So this is the entire opportunity. Just guys, just give me 1 minute. Just 1 second, please. हाँ क्या बोले? रेडी हो गया, आप देख लेंगे. अभी हो गया ना? आप देख लो एक बार. मैं अभी, मेरा वेबिनार चालू है. ओके चलेगा. सेटअप तो कर दिए. हाँ. हम जब तो आपने टेस्ट किया है ना? हाँ सर, ये हमने सर बोले कि एक बार देख लेंगे. अब अभी चालू है, मैं नहीं आ सकता है. मेरे को 1 घंटा लगेगा. ठीक है फिर. हाँ. वो सेट तो क्लियर कर दिए सब. कल मॉर्निंग में आप आ रहे हो ना? हाँ, मैं भी रहूंगा. आता बघितलं ना सगळं. नाही चेअर वगैरे पण आता व्यवस्थित हा ठीक आहे मग चेअरचा काय प्रॉब्लेम ओके सकाळीच असणार आम्ही 9 वाजता ओके Okay, sorry for the interruption. But we were speaking about the opportunity and what is the threat to it. So the company is exposed to India's political, economic, and business environment. There are differences between Indian GAAP and Ind AS, and I think they'll be all outlined by the time the FY18 annual report is out. And any changes in laws and regulations could impact them, but we do not see anything of that sort happening. So, more opportunity than any kind of threats out here, right? So the business is fairly well established, no concerns, and being regulatory in nature, you can be well certain about the sustainability of the business. So what happens is that the visibility of the business, and any disruptions that could come to uh, hamper their operations or get them unstuck looks very difficult, right? So in such a kind of business where the business visibility outlook is extremely buoyant, the only thing that will change out here is the fact that your uh, earning potential changes in relation to the stock markets, right? So to that extent, there will be volatility, right? And let's now undertake the fourth dimension of analysis, which is the peer set analysis and evaluation. Okay, so every time when you take understanding of business, let us look at the following things that we use as a checklist. Okay, when you're doing peer, so capacities. So in the case of CDSL, the main thing is software requirements, software or the system potential for a breakdown. I think we are adequately capitalized on that, and data centers can be easily expanded. So there is not too much of deviation on that. It's not much of a concern. If you take products, fairly standardized products, new products coming in, the new products will be commodities, unlisted shares, and insurance. Services, absolutely essential service, and it is a well documented methodology. Service qualities have been at par. Okay, so there are only two entities, and the board clearly shows manifest trust of the people. So CDSL stands for trust, so the brand is very strong. Okay, proven technology. There have never been major disruptions over the years. Okay, business plan, it is more agile than its competitors, and NSDL, despite being an institutional equity player, and CDSL being more of a retail kind of play, I think it has shown enough fleet-footedness to gain market share. So I think it's more agile than its competitor. Strategy is well laid out. It's same for both of them, right? Execution is the key. There's flawless execution, cost efficiency. So what is here is that there is manpower and there is systems, and these don't change too much. So I don't think that they will be adding significant manpower other than when the new businesses start, but they would be very thinly employed, right? And second thing is entirely systems driven. So the costs are essentially fixed in nature, and hence there is significant scope for operating leverage. We'll discuss that later. Capital structure is fairly benign. Return ratios are very excellent, and valuations, we think they are reasonable. But you know what? These three factors we will look in the next class. Okay. So let's come to dimension 5. So still, we are just repeating what we had learned in the previous classes, but going through an examples. Now here is what we come to dimension 5 is so now that you have seen CDSL, we would like to go and see how the company has performed in the past. Okay, and what are we focusing? So we will be moving away from the presentation and going to a model that I've created, but it's not an Excel as yet, because we will be introducing the Excel to you only when you get into the lecture 5 mode, right? Uh, right. So if you see CDSL, okay, let's see how their revenues stack up. Okay, so this is the total revenues, and your first year is 2013, 91 crores, then it was around 89 crores, then again 105, 122, 146, right? And this tells you what was the CAGR growth over that period. So we divided into two periods, pre 2018 and post 2018. So this is what we had, and then we had 2017 onwards. What happened? So that 146 continues here, and here we are expecting very brisk business growth. So 146 will become 167, 187, 206, and while the growth rate was 12.6%, this time we are expecting a little slower growth at 12.1%. Okay, so now let's go into the breakdown of the revenue and see what are the revenue streams, where are they getting the revenues from. So primarily from DPs, corporate revenues, insurance companies, and revenue from capital market intermediaries. So obviously it's quite visible that bulk of the revenues are coming from the DP side, isn't it? Because in 2013, 40 crores of 146 crores, right? Let's come down further. Which are the other ones? Then you have revenue from capital market intermediaries, right? So these are the big five revenue streams. And if you notice that, so corporate revenues are the big ones. So this is 1:2 revenue from DPs and corporate revenues. So what are these revenues from DPs coming from? Transaction charges, user facility and settlement charges, okay, account maintenance. So these are all, they will only keep on incrementally growing up, right? They're not going to falter, and I don't see people closing down their accounts, isn't it? Even the corporates, more corporates get listed, so these numbers keep going up. Insurance is a fledgling business, and we have not built much into it, but if the dematerialization of insurance policies, and you have revenue from capital and other income from debtors, right? So this is how we have said previously they've grown at 12.5%, आगे जाके 12% growth. So pretty steady business with upside potential built in from where? From insurance and from commodities that we think will grow. And third is the one-time opportunity for dematerialization of unlisted companies registered with the MCA. Okay, so these are more details. I will send these reports, you all can read them on your own. Okay, so these are the new upcoming ventures to lead to more revenue streams, right? So one is the National Academic Depository for academic institutions, okay, eligibility assessment bodies of students, and warehousing that I spoke to you about. So that's a huge data bank. एक घंटे के बाद आप जाओ, हो गया ना आपका? हाँ, सेटअप तो हो गया. ओके, राइट. And if you see the business operations, EBITDA has been scaling up pretty handsomely. So from 70 odd crores 13-14, we have climbed to about 120 crores, and PAT from 50 crores has moved to a base of 80-90 crores, right? So not only has the revenues grown, we have seen EBITDA also grow, and going ahead, let us see how do the numbers pan out. So we are doing an analysis. So we did three things, two things. One is we saw how the past performance was, what were the reasons for the past performance, and what are we talking about the future. So if you notice, we have built in about 14.3% growth for FY18, 12.5 for 19, and 9.5 for 20. So when we did the report then, the stock markets were booming and there was an assumption that more people would join and the revenues would come. So in line with that also, we have seen the EBITDA expected to move from by 50% over 3 years, that is by FY20, and PAT we were expecting to move from 86 crores to 133 crores. So PAT was moving more than this thing because of other income that is coming in, right? And see the earning per share. So earning per share is net profit divided by the total share capital, number of shares. So earning per share. So like you have total profit, you have profit per share was expected to move about 50% in 3 years, isn't it? So having done this kind of construct, okay, having looked at the past and because we've grown 12% historically, we expect to grow 12% this year. We will step back and take a review of the fourth quarter number that came. Okay, we are right now past Q1, but the results are to be declared. So let us see how the performance has shaped up. So the year ended with a total income of 225 crores versus 186 crores, right? And your PAT was about 103 crores versus 86 crores. So just let's go back to our this thing. So we are talking of 225 and 103, right? So if you see, this is far ahead of our estimates. So instead of 166, this has come to 225, and let's break it down into income from operations and other income. So income from operations is 191 crores. We had estimated 166, so we are well ahead of the numbers. And if you come to the total profit after tax, it's 103 crores versus 86 crores. And if we go here, the PAT was, we are very much in line with the PAT. So out of 101, we are 103, right? So what has happened is that the earnings have been good, but I think the EBITDA has come in a little lower. So let's calculate the EBITDA, isn't it? So from 84.2581 minus just the depreciation and amortization, 6.9456, we give you 77 crores, and our EBITDA out here, and our EBITDA out here is 96 crores. So the EBITDA has come much lower than we expected. So what it means is that our expenditure change was much higher than forecasted. So what we will be doing going forward is we will be adjusting this, lowering it, and building that in to modify our model a little bit. So this is what I call adjusting the model. So you build a model, you're validating the model with what happened, you're assigning reasons for what it happened, and then building into your assessment. So then you reproject the model. So that we will look at it next time when you come here. Okay. So this is how we do the analysis for this. And going ahead with the presentation, uh, when you're doing this monitoring work, what are the things you look for? So every data point must be evaluated for comparison with the forecast, right? So when you're looking at revenue, you should compare revenue for value, volume, market share, capacity utilization, inventory, regulatory ceilings, and segments. Okay. So the one just I missed out, there is segments. Then expenditure with respect to the five, which are RM, wages, power, SG&A, and A&P. So RM is raw materials. You should know the input output ratio. So if you're in the manufacturing sector, let us say you're manufacturing steel, and you think that you need X quantity of iron ore and Y quantity of uh, coal to give you Z quantity of steel. So that should be known, right? You should know the price per unit uh, of your raw material, the amount that you need as we spoke. So if you have a capacity of 1 lakh, depending on the input output ratio, you would get the volumes required and price per unit. So that would give you total cost. Now, the price per unit would obviously be impacted by the demand and supply outlook for the input raw material and the factors which are affecting it, and also regulation. Okay, so classic example of regulation is that Tata Power bid for the UMPP project during the UPA regime, and there they were getting mine coal from Indonesia, and Indonesia came out with a paper which said that you cannot export coal out of the country beyond a certain point. So what happened? The coal linkages were disturbed. So regulation will come into play. Now assume that, as we said, we are making steel and the cost of iron ore goes up, right? So the price per unit went up. Now you will go into the demand supply outlook. So when you're looking at the demand supply, you'd have to do an analysis of iron ore market. So what you'll notice now is that because China is not making steel anymore, okay, or rather they're not increasing their quantum of steel supply, uh, the iron ore prices, the iron ore demand is not that high, whereas the supply is ample. So their pricing is low, it's benign, and because they're still cutting back on capacities, right? So what is happening is that Chinese demand being benign has kept iron ore demand easy, and with supply being ample, the pricing is also benign. So here the factor which you analyze was Chinese demand for iron ore. Iron ore is your input cost and its price per unit is low because demand is lower than supply, right? Okay. Then volume is also subject to availability. So is it amply available? So let us say you have a mine in so let's take the case of JSW Steel. Okay, NMDC raised prices of iron ore, so they went and got iron ore from Orissa. Now, because it was available to them, they could do it, right? But let us say that uh, the differential was only 10% and freight cost was about 12%. Then he wouldn't have done it despite being available to you, isn't it? So this is what we spoke about RM cost. Then we need to see wages. So again, comparing steel industry. Okay, JSW Steel does not mine iron ore, does not have coal mines, so they only do steel manufacturing and they have 10,000 workers. Uh, Tata Steel has got 36,000 workers because they have got coal and iron ore linkages and they manufacture steel. And SAIL being a behemoth, which is a public utility, PSU, has got 76,000 workers. They had 96, now they have 70,000 workers. So the number of workers will also impact your wage bill, isn't it? Then your salary, inflation, and if you're in a PSU, the pension, the dearness allowance, the strikes that happen, the efficiency of the workers, all this will impact your wage bill, right? So while JSW Steel is very leanly staffed, in the same segment, uh, SAIL is very overstaffed. Okay, so your wage bills will change. Then we come to power. Now every industry needs power because without power you cannot manufacture, right? So your source of power is important. So whether you're using clean fuel like CNG, or are you based on coal, or are you based on pet coke? Now whether your coal is imported or Indian. So Indian coal has got low calorific value because ash content is high. Imported coal has got high calorific value. Okay, pet coke is a much efficient fuel but environmentally harmful, and there is huge clampdown on that. So then depending upon your fuel mix that you have, or are you into gas, or are you using furnace oil, or are you using diesel, or are you using electricity, or are you using solar, okay, or are you doing waste heat recovery? So all these factors determine the source of power fuel, or you have a multi-fuel injection where you can move from one fuel to another. So if you take Dalmia cement, they can move from any fuel type to any. So they have got a lot of optionality to keep their costs low. Then as we saw price per unit and amount required, input output ratio, then you need to know how much power you need per unit production, what is the pricing, and again demand supply outlook and factors affecting it. So if crude oil goes up, natural gas also goes up in sentiment. When natural oil goes up in sentiment, furnace oil might become cheaper, pet coke might become cheaper, coal has moved down, so we need to see an interplay of all these factors and see how they will impact us. So let us say you are using Indian coal linkages. Okay, so your Indian coal linkages could be a direct captive mine, or you could have got coal linkages from Coal India, or you may be doing buying on e-auctions which Coal India does. So your pricing will change. Okay, or are you blending it, mixing it? So are you using lignite? Are you buying coal from abroad? Okay, so all these things. Are you doing coal gasification? Or are you using CBM, which is coal bed methane? Or are you using NG? Are you using RLNG, which is regasified LNG provided by Petronet? So, what is the pricing? What are the contracts that you have? Okay. So, if you have coal linkages only for 50% of your capacity, so the balance 50% you will have to use an alternative arrangement. So all these factors and the demand supply, as we saw for raw material pricing, will also impact these costs, right? So we need to undertake, when we are doing an analysis, we need to undertake a detailed analysis of all this. Okay, then we need to see other expenses, freight, SGAs, selling and general administration, and A&P advertising and promotion. Then once you have figured out all your costs, okay, you need to check for your gross profit. So gross profit is sales minus manufacturing expenses. Okay, that gives you a gross profit. From gross profit, when you subtract other costs, related to the business, you get what we call operating profit or EBITDA, which is earning before interest, depreciation, taxation. That is important. Let us say you are manufacturing per a million tons of steel. So your EBITDA per a ton of steel is very important. Okay, if you are manufacturing cement, so EBITDA per ton is important. Your PBT is important, your PAT is important. So the absolute numbers are important and margins are only incidental. Okay, so let us say uh, your gross profit, or let's come to EBITDA. Let us say EBITDA went up 30%, but margin dropped 10%. Does it really matter what your margin was? When your EBITDA growth of 30%, ultimately it depends on how much कितना पैसा घर के अंदर आ रहा है ना. So if the income is going to go up by 30%, okay, and if you're going to make lesser margin, so be it, right? So that's what I say. Absolute EBITDA is more important than the margin, okay, because margin is very relative and it's incidental to how much EBITDA you make, right? So there is a lot of uh, unnecessary focus on margins. I'm not saying that they're not important. It tells you how efficient your operations are. Okay. Uh, but absolute growth is more important. So let us say a guy set up a 1 million ton plant and he sets up another 5 million ton plant. If he goes to sell 5 million ton into the market, right, at the same price, he's going to face resistance. So the pricing will come, he'll have to break price because he was first selling only 1 million. Now he's introducing 5 million more. Immediately the market will not be in a position to absorb it, right? So what you have to do, if you have to create the market for that, you have to break the price. And when you break the price, what happens? The margins collapse. But if you're able to do 5 million ton volume on 1 million ton and you break your margin by half also, right? You're still earning 3 times EBITDA. Are you getting the picture that I'm trying to draw? So the growth in EBITDA, growth in sales is far more important than the margin that you get. Also, then you should do an analysis of marginal costing because you should know where your break even lies. In fact, you have 3 break evens. You have a cash break even, you have a payback, right? And then you need to look at debt repayment and capex. So, are you capitalizing your interest expenses in the capex? Okay. What are your interest costs? You also need to look at, for running operations. So, interest cost on the loan. If you have an international loan, you need to know what is the forex loan, at what price, what is the currency depreciation impact you need to build into the loan. So you might borrow at 4%, but if your currency depreciates 4%, you have a 8% cost, isn't it? And your value of your loan also goes up by 8%. So your hedges also, how much you are hedged in the market, what kind of swaps you have. So we need to look at debt repayment and capex in that action. And when you consider taxation, it is very important to see the provisioning that you do. What is the deferred taxation details? We'll come to all these details when we do detailed analysis from lecture 5 to 12. Okay, if you're not paying tax, you're paying MAT. Okay, you might be paying less tax because you are in a SEZ zone where you got some excise benefit or tax benefit, sales tax benefit, right? So you need to do these. Then you also need to compare various ratios. You look at debt to equity, debt to EBITDA, interest coverage, asset turnover ratio, ROE, ROC, and ROIC. So these are your return ratios that we talk about. So all this kind of analysis when you do on an existing business will make you a complete assessment of what the business was and what it is going to do going ahead, right? And one thing that I forgot to mention is that you must do this in relation to peers also. So these ratios will tell you, are you a better player than your peers or not? Obviously, you want to buy a business which has got better growth prospects, is more efficient than other businesses and earning better return than peers, right? So once you've done this, we come to dimension 7, which is the last thing that you're learning today, which is operating leverage and moat. Okay. So, rather than looking at the definition, just look at this graph. Okay. When revenues are growing faster Then expenses, you have what we call operating leverage. Simple. So now getting back to the definition, operating leverage magnifies the changes in earnings, changes in EBIT. Okay, so it magnifies. So if you produce more units, how much more will you make? Because what happens is your costs are fixed. Okay, so in a business like CDSL, he has got only two expenses: software maintenance, because he's already done the capex, and manpower. So if he's got 200 employees, even if business grows 1,000-fold, his 200 employees might become 210 employees. So the relative change in expenditure is far lower than the relative change in income, and that gives you a disproportionate change in the delta as your income increases. And this is what we call operating leverage. Now, operating leverage has its ups as well as downs, in the sense that in a good period, operating leverage will give you great money, but in a bad period, it will hit you also that much. Because what happens, your expenses are fixed, and if you drop revenue sharply, then you will get impacted more aggressively. The operating deleverage in a normal business has got, so in a asset light business, the operating leverage magnifold, or is very high for asset light businesses. And for asset heavy businesses, the operating deleverage also gets magnified intensely. Are you understanding? So you might have a company like Lupin show you 10% revenue loss, but you might see that EBITDA has fallen 30% and there's an operating loss. It's a net profit loss. So what is happening is that there are two components to cost, right? There is variable cost, which depends on how much you produce, and there is a fixed cost which you have to incur, or what we call an enterprise cost. So no matter whether you produce one product or you make 100 products, you are going to incur that cost. So what is it? Manpower, uh, uh, maintenance expenses, selling, distribution, advertising. All these you will keep on incurring. So some of them would be semi-variable. So you might not advertise so much. You could advertise only half. You know, so this is where the operating leverage comes in. And as I told you, CDS is a classic case of operating leverage. So as an assignment, what I would want you to do is I would want you to look at the following businesses. So we are talking of Westlife Development, Titan, Jubilant Food, Reliance Retail, DMart, and Future Consumer. Okay. And I would want you to identify the operating leverage present here in all these 5 companies. Okay. And what I would like you to also do is check 5 companies that declared negative revenue growth. It could be this quarter, last quarter, whenever, and check for the operating deleverage. So when you do these exercises, it's very important that you do them. And these exercises will not take even 15 to 20 minutes of your time. And when you do these exercises, you'll come to understand that 10% in revenue उड़ गया, like 10% revenue बढ़ गया तो इतना negative impact नहीं होता है. So let us say you're expecting 20% revenue growth and you deliver 10% revenue growth and all margins are and all were in line. So yeah, impact would not be that significant. Your net profit would be below expectations. But when you have a negative revenue growth, everything goes for a toss. So there the operating deleverage comes into play. And because I wanted to highlight operating leverage and deleverage, I'm asking you to look at these 6 companies for operating leverage and tell me where the operating leverage is not that material. and check for 5 companies which declared negative results, okay, and see the impact it has on the EBITDA, the PBT, and the PAT. Okay. So let us say a company makes loss, but you still have to pay MAT. So the loss gets even more widened. Okay. And we come to final term, which is the term economic moat. This was popularized by Warren Buffett and refers to a business's ability to maintain competitive advantage over its competitors in order to protect its long-term profits and market share from competing firms. So, in olden times, if you remember the the English castles in fairy tales and all, they would always show you a castle with a hole dug all around it and which was filled with water, and it would have all alligators and crocodiles and all that stuff. Okay. So akin to that, a business has a moat. And what do we mean by a business moat? Where you are able to protect your competitive advantage, right? And also maintain your market share. So these two terms are very important. So a competitive advantage helps you to maintain your profits for a longer period of time and also have a sizable market share. Okay. So a competitive advantage is essentially any factor that allows a company to provide a good or service that is similar to those offered by other competitors and at the same time outperform those competitors in profits. Okay. So a classic example of a competitive advantage in Hindustan Zinc as a company would be the fact that its ore, the ratio of metal to ore, okay, is 14%. What do you mean by 14%? Other mines, matlab if you mine 1 ton of ore, you will get 14% of that, or 140 kgs of pure metal. In other mines, you will get between 3 to 8%. So clearly your operations are going to be low cost. Or if you take the example of Sanghi Industries, okay, very interesting. Its cement manufacturing plant is on the coast. Okay. Second thing, lignite is available in a 50-kilometer radius from 3 mines. So what happens? Lignite is a low cost fuel. Okay. It is available in a 50-kilometer radius, so it has negligible transport cost. Whereas earlier, if it was using coal, it had to be ferried from MP. So carried over 800-kilometer distance, or you had to import it, right? So the costs are prohibitive, and lignite only RM cost was there. There was no overhead cost. So low power cost is a moat for the company, and another moat is that it is on the it is right on the coast. Okay, so it can transport directly by sea. So there is no inland transportation involved. Also, it is sitting on a limestone mine bed. So raw material is also very easily available to it. So its location is its moat. Are you getting my point? And the markets of Maharashtra are much closer to it. And its competitive advantage is also there that the other two players who cater to the Mumbai market, which is which is Ultratech and Gujarat Ambuja, their limestone reserves in Saurashtra are getting over. They're not able to mine them at a very aggressive rate. So what is happening is that uh, this is turning out to be a moat for the company. Its location, its access to raw material, and everything, right? So the operations of Sanghi Industries can be set up at very low cost, low operating expenses. And in the case of CDSL, if the regulatory approvals are a moat, because not everyone will get access to setting up a depository like CDSL, isn't it? So you can be a sub member of CDSL. So a broker can be a depository, but he will be affiliated to CDSL. And the parent body, there are only two, NSDL and CDSL, right? So this is the regulatory hindrance is a moat for the company. So I have an assignment for you on this also. I would like you to identify the moat of all the Nifty 50 companies. Interesting, isn't it? So the idea out here is that we stick to doing these exercises, exploring these 12 dimensions of the fundamental toolbox. Okay, get each concept right, and then we go ahead. So next time when we meet, we will look at one more company and we will discuss assignment 4, 5, and 6. Okay, and please send me your homework. I have not received any homework from anyone. Okay, so I would appreciate that you send me these things. Let's end the class here. I know I've taken less time, but we will make it up in the next classes. So even if you are not doing content is and understanding more important than time spent on the exam. So what I would say is that let's go back, do this homework, and come back next Thursday, and then we will have a full-fledged 2-hour class. In fact, 2 hours would be less from next time because we will be exploring different concepts which require deeper learning and understanding and lot of digressing with examples, and we will be exploring a lot of this. So thank you for having me, and I hope this study of CDSL was good for you. So in my mind, CDSL is a steady compounder because I believe that there are enough triggers in place to grow revenues multifold, and with cost being limited, it can seriously add to the bottom line. So if you have any queries that need to be addressed, let's take the next 5 minutes to address all those queries. So can you WhatsApp me all your queries and we will take it up from there. So Gurji is saying Crisil Ikra have moat, that is a government license. Yeah. Asim, what is this cosmic films that you send me? Cosmo films? Okay, you've done your analysis. Fantastic. So I've got one homework which has been sent to me. So all the other people, can you also catch up with Asim? So Asim is attending his first lecture, but he has done his homework well before that and come. And Asim, I will go through this and we will discuss this in the next class. Okay. Anyone else? Gurjeev, how about you? Yeah. Imami, he says, has banned mode. Kesh King and Zandu. Okay. Brand. Okay. So, a Colgate would be a brand mode because you don't say Colgate leke aao, you understand you want to get toothpaste. But if I tell someone Kesh King leke aao, he might not grasp what it is, right? Or Raymond is a brand mode because Raymond stands for men's clothing and it means quality and expensive clothes, and it's an age-old brand. And if I say Godrej, it's a brand for trust. So that's a mode, and that is why yes, Jockey is a brand mode for Page Industries. And Godrej that is why Godrej can sell 500 crores of property deals in a day, and other brokers in the vicinity and around their projects struggle. So having a moat is a competitive advantage. and it is phenomenal. So, okay, then let's wind up the class, and those who could not attend today can listen to the recorded lecture and the presentation notes. I will share with you uh, in a short while. Okay. So thank you once again, and we will meet next Thursday at 7:30 p.m. So please complete all the 6 assignments that have been given to you and come. Okay. So like a school teacher, let me tell you, if you don't do your assignment, you will not be allowed in the class. Cheers. Bye.